More pessimistic forecasts of global growth, coupled with the risk of financial crisis in Europe, are problems for Gaia Capital Advisors' Coast Sullenger. He joins us live now from Geneva. Coast, it's great to see you. I want to start out, first of all, with China. We constantly talk about how this is the world's biggest consumer of raw materials. How crucial is China to the commodity prices?
Hi, good morning. It's very crucial. China has become as you mentioned, the largest consumer of many commodities. In the case of iron ore, it's over 50%. In the case of copper, it's something around 35 to 38% of world consumption. And it's the biggest growth driver for other commodities like energy commodities like crude. So any kind of slowdown in China would obviously have a big impact, and is having a big impact on the commodities, that's for sure.
So the correction that we're seeing over the last couple of days, is that justified? Are commodities overbought?
I think they started from an overbought position. You mentioned some percentage drops, and they look pretty dramatic, but if you consider where those commodities were, they really came from very high levels. What concerns me the most, I would say, and this is the reason that in our funds we've been light in the base metals and the industrial metals, is because those commodities are trading at such levels so much higher than their cost of production. In the case of copper, for example, the average margins now are like 60%. These companies are just printing money. So if the price continues to be soft, the producers are just going to make the situation worse. They're going to keep producing because copper around $3.50 or $4 today, they're producing at an average cost of like $1.20. So they're going to keep producing even though the price comes down. So I would be cautious there.
So the producer margins are going to come down. Yeah. They've only got one way to go, is what you're saying. And you're actually not investing in commodities directly. You're investing in companies that deal in commodities. That's your strategy. So actually on the side of gold, you say there's still upside.
I do believe so. Yeah, we're very bullish on gold. It's the main drivers are the same. I mean, look, we've got about $15 trillion in debt in the United States. We have about $9 trillion in debt in Europe. This indebtedness is a major problem. It's going to slow growth. The unwinding of that debt, when and if and how it happens, is going to be bullish for gold. And in the meantime, countries like China, who hold massive amounts of U.S. dollar debt, they're looking to diversify. They currently have officially less than 3% of their reserves in gold compared to much higher levels around the globe. So the choice is obvious, and that's where a lot of the buying is coming from.
So how do we ride that wave?
We think that's going to continue.
Which shares do we buy to get in on that?
Well, I think gold shares are the way to go because the gold shares have vastly underperformed the underlying gold price in the last 6 months or so. And today, judging by their valuations, price to NPV, et cetera, they're at historical lows. So I think definitely you want to buy into gold shares. And incidentally, by buying gold shares, you essentially can get exposure to underlying gold between $300 and $600 an ounce, whereas gold today on the spot market is $1,750 an ounce. So you're getting a very big discounted way into gold through the gold shares, actually.
So quickly and finally, there's another sector that you like, soft commodities, agriculture shares. Tell us about that. How come?
Well, I mean, clearly we're in a world of crisis, but so far as I've seen, people haven't stopped eating, and we just broke the 7 billion mark in terms of population, and that number keeps on growing. And the FAO says that by 2030, food production has to go up by 50%, and by 2050, food production has to grow to meet growing demand by as much as 70 or 80%. So the backdrop for agricultural commodities is extraordinary, and the stocks have never been cheaper. The equities are trading, the farming shares, which we love, are trading below NAV. For companies which actually have good margins and good growth. So explain that they're trading 30% below NPV. I think it's an extraordinary opportunity to buy them. They're trading also at very low multiples on price earnings, 5 to 6 times earnings. It's really a unique situation. So I would definitely encourage investors to look at that as well.
Coast Sullenger of Gaia Capital Advisors, thanks very much for being with us from Geneva this morning. Thanks.